Now this last category down here may or may not apply to you, and that's PMI. And we talked about PMI earlier, where again, that's the insurance protection that the banks make you pay if you don't have 20% down. And that helps in case you stop paying on it, the bank has to foreclose, they sell the property at auction or on the market, and they don't get back at least what you owe on the property. That insurance kicks in and pays them the difference. Well, if you have a conventional loan, you're going to have PMI. If you have an FHA loan, that's called MIP. One thing that I may not have made clear earlier is on a conventional loan, your PMI will go away after you've reached that 20% down threshold. On an FHA loan, in most cases, it never goes away. So you're going to have that all the way until you pay that loan off entirely. Now over here I've got written LPMI, and that's another category. That's LPMI stands for lender paid mortgage insurance. Now the banks aren't going to just pay your mortgage insurance for you out of the kindness of their hearts. What this is they are saying, hey, we'll take care of the PMI, but in exchange, we're going to give you a little bit higher interest rate. So what they're doing is they're taking the money from the extra interest that they're making, and they're paying the PMI for you. You might say, well, why would you do that? Well, this used to be more of a tax strategy, and it still could be effective for you. So I would highly recommend you talk to your CPA when deciding which mortgage option is the right one for you. But previously, PMI was tax deductible for households that made less than $100,000. Now, PMI is no longer tax deductible, so this may put more people over here in the LPMI bucket. Think about it this way. If I'm trying to maximize my tax savings, I want to be able to deduct as much as possible from my taxable income. In most cases, the mortgage interest that you pay is tax deductible. For most persons, this is going to be up to $750,000 of your primary mortgage. So if you bought a house or you mortgaged your property for anything $750,000 or less, that mortgage should be tax deductible. Now, disclaimer, I am not a CPA. I don't pretend to play one on TV. So you want to talk to your tax preparer about this, but the mortgage interest is tax deductible. And then previously, PMI was tax deductible for household less than $100,000. Well, if you happen to make good money, you're making over $100,000, or again today, PMI is no longer tax deductible. If you do LPMI, yes, you're going to get a little bit higher interest rate, but that's all interest. That's all tax deductible, as opposed to only being able to deduct the interest and not the PMI portion. If you move all of it under the interest category, you can now deduct all of that from your taxable income. So again, talk to your financial CPA, tax preparer, get their opinion on this, but this could be a way to maximize your tax savings benefit.